Good morning. It's the day after. You're watching Trading Hour. I'm Reema Tendulkar, and with me is Surbhi Upadhyay, and it just feels business as usual. Large caps are consolidating. The activity, the rally in the mid caps continues. Even though there are so many voices who are pointing out that the mid caps are expensive, it's trading at a 50% premium to large cap. But look at the mid cap index. Look at the small cap index. The advanced decline ratio has 4 stocks gaining for 1 stock declining.
Absolutely, Reema. I mean, the market's really moved on. I think it started moving on yesterday itself. The only thing is that the fall in the bank stocks is a bit telling. Once again, even this was the same picture yesterday. Remember, the bank nifty was one of the weakest spots of the market, and that's continuing. So there's follow-on selling in banks. And that's a little bit of a spot of a bother. You can't take your eyes off that. So even today, so Bajaj Finance has a reason. It's reacting to numbers, and those margins are lower than expectations, etc. But look at the banks. Axis, ICICI Bank at this point in time, State Bank of India, Indus and HDFC Bank. There's across the board selling coming in. So from the bulls' perspective, this is going to be a bit of an issue.
Axis Bank, by the way, reports numbers
today as well. Yeah, exactly. So let's see. I mean, if the numbers can, part the clouds to an extent. And
because so far it's been a mixed bag. HDFC Bank was fine, pretty okay. Kotak disappointed the streets. So Axis Bank will be the third large cap private sector bank to report numbers. Absolutely.
So we'll watch out for that. The other trend that stands out today is that once again, just like what happened, you remember on counting day, that on that day, FMCG rallied, but there was no follow-through. So once again, if you look at stocks this morning, Lever is down, despite pretty decent numbers. You're seeing that play out on some of the other names like Nestle, Britannia. A lot of these stocks are also on the lower side. So FMCG is not seeing the follow-through. So what is rising then? Well, you've got ONGC in leadership position, Coal India, BPCL. There's, of course, Reliance that's really helping. ITC is still celebrating the fact that there's no further increase in tax on cigarettes. But I think, Reema, the PSU side of the market, yesterday they were down and out. Today they're saying, hey, we're back.
We're back. The Nifty CPSE index should come up for you on your screen, and that's up nearly 1.5%. But let's get down to business then. Shibani Sarkar Kurian from Kotak Mahindra AMC joins us on the show now. Shibani, it's absolutely outstanding, right? The way the markets recovered after election day. Yesterday, perhaps there was a little bit of a wobble, maybe for 1 hour or so, when the markets fell 500 points in the Nifty. But after that, it recovered and is holding. And we keep going back to that example in 2018 when there was the first increase in LTCG. Markets did correct, not on the day, but with a lag, there was a correction seen in the markets. Do you think, how would you read the near term for the markets now post the budget?
Hi and good morning. Yes, if you look at the budget, there are lots of positives that the market is taking away. I think the biggest positive that has come through from our perspective is that the fiscal consolidation priority continues to be maintained. And if you look at a consolidated fiscal deficit, which is both at the center as well as at the state, the number seems to be coming down. And going into FY26 with a 4.5% central fiscal deficit expected, that number is likely to come down further. So that bodes well from both a borrowing perspective as well as with hopes of a rating upgrade, because a lot of the external rating agencies look at debt to GDP ratios as well as consolidated fiscal deficit. So I think that's one big positive from a budget, which the market is possibly taking on board. The second factor is that the budget does a balancing act between both investments as well as spurring some amount of mass consumption with some of the tax changes that have been brought about, as well as the fact that if you look at on an overall basis, with both on budget as well as the IEBR expenses in terms of capital expenditure, the growth seems to be fairly strong over the revised numbers for FY24. So I think that's another key factor that the market is looking at. Of course, from a near-term perspective, I think the tax changes, especially by long-term capital gains as short-term capital gains as well as STT, that's a bit of a dampener for the market. However, remember, there have been tax changes across all other asset classes as well. And if one has to look at a silver lining, the tenor for long-term capital gains tax has not been changed, and that's still 1 year. From a market perspective, in the short term, I think market just goes back to focusing on earnings delivery. We are in the middle of the first quarter earnings season, and so far numbers have been somewhat muted if you look at the overall aspect, especially because of OMCs as well as metals. But X of that, numbers have been largely in line with estimates. So I think now it's back to business as usual, looking at earnings and valuations now that the policy direction has been set by the budget.
All right, fair enough. So those are opening thoughts and your take on the budget, Shibani. Let me just draw your attention to this constant selling in banks, right? Now, we're just trying to figure out whether there's anything additional in the budget yesterday that's compounding the selling, or whether it's banks reeling under their own known issues, right? We know deposit mobilization has been difficult. And I don't know if this 12.5% LTCG, whether that's going to make people, leave their money in the bank deposit and not put it in the market. That seems highly unlikely, right? But just your sense, because the selling is quite excessive, and this results season hasn't exactly, thrown up too many positive or sort of bright points with respect to banks.
So absolutely, Surabhi. I think the biggest factor to monitor where banks are concerned is the pace of deposit mobilization. Banks, as you know, over the last few quarters have seen pressure on net interest margins, primarily because cost of deposits have been rising. And there's also been repricing of the past deposits, which has led to this pressure that we have seen in terms of margins. Deposit accretion does continue to lag credit growth. And I think that at the margin, we have to take that into account when we are looking at the overall earnings as well as return ratios for the banking system. Now, if you look at last few quarters, there has been some uptick in terms of deposit mobilization, but it is still not enough. And therefore, the expectation is that the credit deposit ratios for banks would possibly moderate, which will have a bearing on margins. However, on the positive side, when you look at the cost of deposits seem to be largely stabilizing. Banks are now looking at better productivity in terms of their own branch network to raise liabilities and not just looking at the cost front. So from that perspective, I think margins should start to stabilize over the next few quarters. If you look at the large private banks are still holding up in terms of both their ROA, ROE profile. Margins seem to be, again, as I said, possibly bottoming out, and valuations are in your favor. So in the entire BFSI pack, we think that some of the larger private banks seem to be well placed, specifically with respect to their valuation as well as return ratios, and risk reward is in your favor at this point in time. But we'll have to wait and see for the next 1 or 2 quarters in terms of the margin trajectory for some of the re-rating to possibly start. And of course, the ownership level across most of the large private banks is high, specifically where some of the domestics are concerned, and even the FII ownership, while it has come down, still remains high. And that could be another reason, which is why, the sector has seen the kind of pressure that it continues to see.
Any other changes that you would recommend in your portfolio? You have to keep rebalancing your portfolio. Some things come in, some things go out. So take us through the changes for the next 6 months. Which is the sector which, according to you, might lead? You spoke about financials in details, but outside of that?
Yes, so, there are 2 sectors that we are incrementally evaluating where, again, we believe that risk reward is in your favor. One, you alluded to the consumption space. Of course, the big bang expectations that, we went in terms of the budget, providing a lot of support to the consumption sector. Maybe some of that has not played out. But if you look at the fine print, there is adequate support which has been given to the middle class and to the rural segments in order to spur consumption. That, along with the fact that monsoons have been fairly normal as of now, and at the margin we do expect that agri, especially the kharif output, should be a good one, along with input cost pressures coming down, which would mean that the rural wages, especially on the real rural wage perspective, should start to improve. And therefore, if you look at consumption, especially with respect to valuations and their history, that sector looks to be fairly well placed. So that's one segment that we incrementally are positive on. Banks we already spoke about. And the third aspect that, where risk reward seems to be in your favor, especially where valuations are concerned, is possibly the large cap tech names. Again, the commentary from most of the companies that have reported numbers seems to suggest that a lot of the pressure that you are seeing, especially on terms of discretionary demand spends on the BFSI space in particular, seems to be bottoming out. North America is seeing some revival, which is also what the commentary seems to suggest. And therefore, that's the other sector that we are evaluating.
So IT, consumption, and overall on banks, you're not trimming positions, despite all the concerns you laid out, right, Shibani? What's the overall stance on banks?
So banks, Surabhi, we are positive, specifically on the larger private banks, where we think that, valuations are in your favor. So the large cap private banks is where we are positive on.
Okay. Thank you. Great conversation, Shibani. We look forward to the next one. Get into a break on that note. But, getting incrementally bullish in technology gives us our cue to invite the management of Zensar Tech, which reported their numbers recently. Good top-line growth of more than 4%. We'll discuss the way forward with Manish Tandon on the other side. Welcome back. Let's move the conversation now to Zensar Tech. They reported their numbers on Monday post-market hours, but yesterday, with all the budget-related announcements, we didn't get a chance to chat with the management. A quick recap of the numbers: strong top-line growth. The company's reported an over 4% revenue growth, 4.3% constant currency quarter-on-quarter. Margins, though, have declined because one of their clients went bankrupt, and the company has taken a provision of 110 basis points on the margins because of the bankruptcy of the client, and therefore their profits too have come down by nearly 9% quarter-on-quarter. Manish Tandon, Managing Director and CEO at Zensar Tech, joins us on the show. Manish, morning. This is Rima here. First, on the top-line growth, 4.3%. This bankruptcy of the client, you've explained, impacted your margins, but did it also impact your top line? And what can you guide on revenues going forward? Because in the conference call, you sounded a bit cautious.
Yeah, so first of all, on the bankruptcy of the client, this has not impacted our top line because the client was relatively small, about $1 million per quarter. And we, as per Chapter 11 laws, any work that we do post the announcement of bankruptcy is covered. The revenues from that are covered. And also we are one of the critical vendors and the chair of the creditors committee. So there is a chance that we might be able to collect more than what, at least some amount that out of the total outstanding.
So what is the outstanding?
1.7 million.
1.7. Okay.
About 1.7 million or so, 1.1% of revenues is the outstanding. And on future, I think, again, we don't give future guidance, but there are, as usual, there are some headwinds and there are some tailwinds. Headwinds are that one of our TMT clients has announced a furlough in July, which is something new. So that was not anticipated. Also, the second thing that I'm seeing is because of this, I'm anticipating that because of this CrowdStrike thing that has happened last week, we might see a diversion of funds away from existing large projects to a little bit on the beefing up on the security and the robustness of the IT infrastructure. Now, this has happened in the past, and I am anticipating that we might see something there. So those are the headwinds. The tailwinds continue to be that our businesses seem to be doing okay. This was the second quarter in a row where all our verticals actually grew sequentially. And that is a positive sign. So as I said, I mean, you have to balance the headwinds and tailwinds and see where you land up.
A fair point, Mr. Tandon. It's been a challenging start, and from what you say, all the challenges aren't over yet. So all things put together, now you have this other client that's going into furlough from July. I think you also have a wage hike coming in that will be effective July. So should investors be prepared for more sluggishness on the top line? Also the margins, we just put out a graph that Rima shared with us. overall margins have been on a declining trajectory from 18%, I mean, sub 16%. So will we see more of this before things get better? How, the outlook, given what you're saying, seems like it's going to be more sluggishness in Q2, Q3 perhaps.
So the margin chart, if you look it up and if you adjust the margin for a one-time bankruptcy, then our adjusted EBITDA margins this quarter is 16.3%, which is in line. Actually, 15 also is in line with the mid-teens guidance that I have been giving in the past. Last year, our margins were a bit higher because we wanted to invest in growth. And as I said, we've tried to make sure that we have balanced growth between revenue growth and margin growth. So that is where, as stated previously to the investors, margins will be in the mid-teens range because we are going to invest for growth. And it's good to see that some of those investments are bearing fruit. Sequentially, Q4 to Q1, 4.3%.
But sir, are you confident of growth? I take your point that you've sacrificed margins a bit because, I mean, that growth number, the top line number is no doubt looking very good. But are you confident of top line growth given all the headwinds? The furlough, the other client which has gone into bankruptcy, this CrowdStrike business, I mean, this is a fresh issue that you described. Could Q2 actually be flat?
I'm cautiously optimistic. Let me put it that way. But again, the game isn't over till the final whistle is blown. So we will see where we'll end up. But I'm cautiously optimistic that we will continue to have revenue growth.
Have you had any initial conversation with clients about moving some work away from the large projects to beef up the internal security at enterprises post the CrowdStrike outage that we had? Because you alluded to it as a potential headwind. So what are initial conversations like? Why are you so fearful this might happen?
To be frank with you, this happened just last weekend. In fact,
Yes.
even my flight got cancelled. So it's too early to have those client conversations because everyone is busy with the disaster recovery thing. In fact, Zensar teams have received a lot of commendation from clients because of our performance in helping them recover from the situation. And there's a particular city out there where even the police department has given us a glowing reference for the work that our team did last in helping them recover this thing. I am just basing this on what I have seen in the past. As you know, I've been in the industry for 30 plus years now. So what I have seen in the past, I'm basing it based on that rather than on client conversations.
Okay, and what happened in the past? If history has to rhyme?
What happened is exactly what I said, that when a major security incident or a DR incident happened, you see a shift away from capital projects to more of beefing up of the security and DR infrastructure.
Big impact? Are we talking about large sums being pulled out of projects, existing projects?
Large is a relative number. So we have to, for a large company, it will be large sum. For a small company, it will be a smaller sum.
But across the board impact, that's an important one and something that, we'll take it forward even with our other conversations with a lot of the IT companies. Let's see how this plays out. Thank you for joining us, Mr. Tandon. Good conversation, and we wish you good luck for the rest of the year. That's a conversation from Zensar. Frank, they've had an issue with one client in this quarter, maybe some more headwinds ahead as well. Stock, however, is holding up. It's done well in the last 6 months, still holding up today. Let's take a break on that note. We'll come back on the other side. And we will be in conversation with Mitesh Thakkar. Let's see what trades you can work with this morning. Welcome back. Well, let's straight away head across to Mitesh to figure out what trades you can perhaps look at. Mitesh, good to be speaking with you. So it's the day after. What do you make of things? Banks are still feeling a lot of pressure, but the broader markets bounce back. So what trades now?
So we have raised a very important point. The bank Nifty has, started trading below 51,450, 500 levels. That's a negative. And, there is mild support at 51,000, but I think it can go to about 50,500. So it is the banking pack, which is putting pressure on the Nifty. And in fact, today morning I suggested don't trade the Nifty because the bank Nifty could, turn out to be the weaker spot and which also enjoys a significant weightage in the Nifty. So I think that's playing out. And therefore, clearly avoid the indices, or, you may want to take some selling some out of the money call options in the banking names, or even buying put options. I think both of them is okay. And disclaimer that we have some put options positions for the August expiry in the bank Nifty. So we have a negative view. On the stock side,
More downside.
Yeah.
No, go ahead.
So I said on the downside, I think Sun Pharma is something, which is showing, on the stock side, Sun Pharma is, which is showing some kind of positive traction. So buy here with a stop at 1597. Look for a target of 1650, 1660 to begin with. We may eventually look at higher levels. And the other stock which I have is IndusInd Bank, which is a sell with a stop at 1414 is the stop loss and a target of around 1365, 1361.
Okay. Thank you very much for that. The fall in banks is concerning, and Mitesh is pointing out there is more downside in store. The Nifty Bank could go down to levels of 50,500. Right now, a Kotak Mahindra Bank, State Bank of India, these stocks are all at the day's low. So the selling continues. Even an HDFC Bank has extended its fall. Thank you for joining in, Mitesh. We need to get into a short break. We'll come back with more.
Welcome back. Well, it's the tax and capital market discussion full throttle, because not in the recent past have we had a budget that is so heavy on taxation that directly impacts the capital market. We've got changes in STT, we've got changes in the long-term capital gains tax regime, as well as, of course, what's happened with buyback. So let's discuss all of this one by one, and we have a full house for that. We have Mr. Dheeraj Relly, MD and CEO at HDFC Securities, who's, of course, representing the broker fraternity. We have Deepak Shenoy, founder of Capital Mind, who's the voice of the investor. And we have Girish Vanwari, founder of Transaction Square, who's the tax expert, of course, on the panel. Gentlemen, thank you very much for joining in. Great to have you on. I want to start with STT, because yesterday all the limelight was being hogged by, I think, buybacks and LTCG. So on STT, Mr. Relly, if you could open the floor, because I think going into this budget, the whole hype and hoopla was around curbing speculation. The STT hike has come in on futures and options. It's a big hike, I think as much as 60%. What's the impact?
So first of all, I want to clarify everyone that this hike will be applicable from October 1st and not with immediate effect. So that's something, there was a confusion yesterday, but now we have a clarity on the same. You're right that this is a significant increase in the transaction cost for the traders and investors. So to that extent, it will have its own impact on the volume. We did some maths to check how much will be the impact if on sale of securities options. You will have impact of almost 50%. And if we include sale and purchase both, because STT is applicable only on the sell side and not on a buy side, the impact will be almost 21%. So 31% impact on the sell side of the transaction, 21% impact on the sale and purchase both leg of the transactions. This is in the case of sale of options in securities. If we talk about the futures, I think the impact is slightly higher. Impact is 50% on sell side of the transaction, and here the STT is charged on the contract value, and in case of options, it is charged on the premium. If we include sale and purchase both transactions, the impact will be 39%.
Okay, so could you just, for our benefit, repeat the numbers? I think, and let's start with options because that's where the whole discussion is. On options, you're saying that it's 31% and 21%. Is that right?
Yeah. So let's look at option premium of premium value of 1 crore. In the 1 crore, the transaction charges will be 4950. That will remain the same. We are assuming that the transaction charges will remain same. In fact, you must notice that this is also up for a revision effective October 1st. This will revise downwards, but we don't have any visibility as of now. That's where, for the purpose of calculation, we are taking 4950 per crore as the same charges for the exchange charges. And we are keeping all other charges same, not taking any charges impact of the brokerage. So we are just calculating the impact of the STT only. So STT on 1 crore premium value earlier in the old taxation was 6,250. Now it will move to 10,000. So this would translate into an impact of 31%. And if we include both sides of the transaction, sell and buy, this will be an impact of 21% because the charges will remain on the buy side of the transaction, which is 6163 per crore.
So Girish, you have a pulse of the market. You speak to all the clients who trade with you all and do brokerage. Do you think it's a sizable increase we're talking about? Will it curb speculation on F&O, to your mind?
And this is not the only thing. There are three things to be considered. First was the size of the F&O, which got increased, SEBI's proposal to make from 5 to 25. Second was the margin trading restrictions of 1,000 stocks, which could not be pledged. And third is this. You add the three up, people are nervous. And today I was just speaking to people. Today, if you sell, square off your positions, if you sell your MTF positions, effectively you're paying a higher capital gains tax too of 20%. So really, to sell or not sell also is a big question, because should you book a gain, which is at 20%, because many of these scripts have also gone up. So it's going to impact the market.
So, Deepak, come in on this. I think the numbers Mr. Relly has given us. The question is, does it curb speculation? It's a big hike. He's put out the numbers, 21% to 31% on options. The tax itself has gone up by 60%. Does it curb speculation?
No, I think the problem with speculation is not the people who pay 1 crore in premium. They are relatively small in numbers. So take a person who pays 1 lakh rupees in premium, which is probably still the higher end of the speculatory. Speculation is not bad. It is this unbridled gambling that is bad. And a lot of people look at speculation as gambling, but it's not. In the stock market, there is difference between a casino and the stock market. Is the stock market, the house does not take all the winnings. The winnings are, you can be a winner regardless. In a casino, if you win consistently, they throw you out. In the market, you can win consistently and continue to exist and be there. The problem with speculation is usually the small person who does not have too much money leverages themselves by taking a loan and then leverages themselves in the market as well. So on 1 lakh, the difference is maybe 30 rupees. Now, for a lot of people, this 30 rupees is not meaningfully different, or maybe I don't know if it's 30 or 300. I think it's 30 rupees. But the actual numbers is not so meaningful that people will get deterred by STT or by a larger capital gains tax, because if they were making profits, then they would be worry. But then the problem, as stated, is that the speculation is bad only because a lot of people lose money. If they're losing money, they're not paying taxes on that money at all. But I think the STT itself is not meaningful. It will hurt non-speculatory activities, such as even arbitrage funds, who will see a 20 to 25 basis point decrease in their yields simply because of the higher STT on futures. But the options piece, I don't think it will curb speculation meaningfully. It's just, there's a lot of money being made in options, a lot of, transactions happening in options. The government's like, if you guys are willing to pay, I might as well charge a little bit more, and let's see where you stop playing this game.
It's the golden goose, right? Laying golden eggs right now. Dheeraj, come in. Your view. In absolute numbers, it doesn't appear to be significant, though in percentage terms, it does look like a very significant increase. Will it curb speculation?
So Deepak is absolutely right. Even if we do the math on a 1 lakh option premium, the current cost is government charges are 90 rupees and it will move to 27. So it's almost an increase of 30 rupees only, what 37 rupees what Deepak has mentioned. See, you have to take this into account that these transactions are done on a wafer thin margin only. So to that extent, it will have its own impact. It's not just a sentiment impact, it's also the real math, real gain or loss impact for the investors. And if you look at the overall FNO volume, 50% of the volume is done by the prop traders as well as arbitrageurs. So particularly they operate at a wafer thin margins. So to that extent, when their impact cost will increase, the transaction cost will increase, there we will see the impact of the volume. And I also echo the sentiments expressed by Girish. It's not just the impact of the transaction cost attributed to the securities transaction tax, but also the overall action taken by the regulators also. And there are more action on the anvil. We will see that there will be more actions coming in the forms of some more radical changes in whether how many expiries per exchange can be there, or maybe a lot size can also go up. So if it's the culmination of entire impact, I think that will definitely address the speculative activities in the FNO space.
Okay, got that. So let's see. Maybe this is not the end of it. This is just from the tax perspective. Let's see what SEBI now, what prescriptions SEBI finally prescribes. Gentlemen, let's move to the next issue, which is buyback tax. That got a whole lot of debate going yesterday as well. Now, first of all, let's get clarity from Girish. Girish, the interpretation that I got was it's very simple. The arbitrage between dividends and buybacks goes away. Dividends were being taxed in the hands of the recipient at the slab rate. And now the same will happen for buybacks. Tell us if that's right. And I think the price of the share, that can be taken as a capital loss, which you set off against a capital gain. But basically, is there any arbitrage left at all?
Actually, I want to twist this. Clearly, if you look at it purely as dividends and buyback tax, which is 20% versus a dividend tax of 35%, you can say the arbitrage has gone away. But if you put a treaty into play, let's say foreign companies investing through Singapore or Mauritius or directly through Netherlands, UK, the answers may be different. Actually, they'll come under dividend taxes. In Mauritius, the dividend tax rate is 5%. In Netherlands, it's 10%. You may have a better answer to yourself. Then you twist it even further. You look at open market purchases for buyback. You look at tender offers in buyback. Tender offer in buyback, I understand the law is very simple. Now it will be taxed in the hands of the respective shareholder at his rate. But look at open market purchases. If you do open market purchases, you will sell on the stock market paying STT. You don't know when the company is gradually buying. And when you pay STT, you'll pay 12.5% depending upon long-term, short-term. And then the company will also argue no taxes. So if you were doing open market purchases, can you actually say there is no tax on buyback now? Because you'll anyway pay the lower amount of capital gains tax. And to the company, there is no buyback tax. So really, this whole section needs to think. Other queries which I'm getting today and yesterday is that what about buyback announced? At what point of time will this be applicable? The law says it's applicable effective October 1, 2024. Now, one is the announcement of buyback, board resolution for buyback, shareholder resolution for buyback, if applicable, opening of the tender offer. At what point of time do we have to look at October 1? What happens to shares tendered before October 1? It's clearly under the old law. Shares tendered after October 1, after the, it's as per the new law. Yeah. What does tendering means? Tendering means what is the point of time? It's the point of time when the company accepts the buyback.
No, fair enough. Girish, just to clarify, making it very simple for viewers who are watching, as per the new law, as per now the way things stand, when there is a buyback that's happening through the market route and I'm tendering in my shares, first of all, I have to pay STT on that trade. I'll have to pay capital gains, which is long-term or short-term. And then when the company eventually gives the income back to me, which is now going to be dividend income, then I have to pay tax at my slab rate, right? So that's 3 taxes.
No, so when you offer it for buyback, when you give it in your tender process, there is no tax because you're tendering the shares to your company. So there is no tax on that point of time. When you get the money, when the company accepts your tender and gives you the money, at that point of time, you pay dividend tax. And afterwards, because you have tendered your shares and got money and paid dividend tax, there's a capital loss in your hand, which you can set off. So at the time of offering to tender, there is no tax. When you get the money, there is tax.
Got it. And that will be at your slab rate. Deepak, this entire buyback is a critical issue for IT companies because they annually give you a buyback, and most of the large cap IT companies have very high promoter holding. So give us your take on this entire buyback versus dividend.
So Rima, nobody's going to do a buyback anymore. I think that's just very clear. I would, as a promoter, absolutely not do it. The only people who benefit from buybacks now are mutual funds. And insurance companies or pension funds and so on, who are not who don't pay tax, right? So if I was the promoter of a company and I had to pay, I had to participate in a buyback, I would have to pay a certain amount of money to buy back my shares. From April 1, by the way, there's no open market buybacks allowed at all. The buyback regulations have changed to only allow tender buybacks after April 2025. Right now, there's a small window till then. But then, the buyback concept was, instead of paying a dividend, I'll do a buyback, and then the cost is roughly the same. The company pays the tax of 20%, and people get it tax-free in their hands, which is actually worthwhile for a lot of promoters to be able to take money, whether it's a TCS, the Tata, and by the way, we have a holding there. But TCS gets a significant amount of its money from TCS. Tata Sons gets its money from TCS in the form of dividends and buybacks. But why will they take money, pay 39% on it, and have this large amount of money lying around as a capital loss, which may not even be a large amount of money, simply because they might have bought the shares at a much lower price. Yeah. So
on the whole,
so how do you repatriate income? If you have to do either dividends or buyback, so what will companies do?
Dividends. Why not?
Dividends. Okay.
It's a lesser problem.
So if earlier, suppose a company was doing 1,000 rupees worth of buyback, now the amount that they will give, considering all the taxation, will be lower than 1,000. Because one reason for buying IT companies was also the kind of return that they give back in the form of dividend or buyback. So will that be lower?
I think it will be 1,200, because if they did a buyback at 1,000 crores, they had to pay 200 crores as tax separately, right? So they were actually distributing 1,200 crores. 200 was going to the government. Okay. Now they have 1,200 to distribute. They will distribute the whole 1,200 as a dividend and leave it for you to pay the taxes.
Okay, all right. We have to pay the taxes. That's the bottom line. Come what may, and whichever format they might take. Gentlemen, thank you very much. We're out of time, but definitely not out of questions. These are complex issues, and I think we'll have more of these conversations to get further clarity. Thank you very much, Mr. Relly, Girish, Deepak, for joining in and demystifying some of these taxation points for our viewers. Right now, take a very quick break. We'll come back with a lot more on the other side, including several stocks that are in focus today.
Welcome back. Banks take center stage, and today Federal Bank will be reporting numbers. Abhishek joins in with the key expectations. Abhishek.
This will be the 56th and last board meeting that Mr. Shyam Srinivasan will attend for Federal Bank's quarterly numbers. So take a look. Our poll suggests that the growth will be healthy. They have already given a business update. Net interest margin is expected to remain flat on a sequential basis at 3.2%. Now, analysts are pegging the slippages to be in the range of 450 to 550 crore. Seasonal in nature, that Q1 slippages do spike up versus Q4. However, asset quality can remain stable. Motilal Oswal expects gross NPA ratio at 2.1%, which is the same that was there in previous quarter as well. Operating profit growth is seen at close to 11% YOY and 30.2% quarter-on-quarter as per Kotak Securities. Focus will be on commentary that the management gives with respect to outlook of the bank in the near future. Our poll suggests an NII growth of 19% YOY and 4% sequentially. We are working with a profit growth of 10.8% YOY and about 4.5% sequentially. Thank you.
All right, Abhishek, thank you very much for that. And with that, move on. MSCI is slated for a review next month. Vivek is joining in with a list of the likely inclusions. Vivek.
Well, good afternoon. That's right. So the reason we are highlighting, this particular development today is the fact that sometime in the course of the last week and in the first two trading sessions that we have witnessed of this particular week would have been the cutoff date for MSCI to go ahead and consider the likely inclusions and exclusions of stocks into the MSCI August, potential review. So when is the announcement expected? The MSCI announcement is expected on 13th of August, and the actual adjustment will take place on 30th of August. So, it's expected to be, net inflow event as far as India is concerned. As per IIFL, there are almost 7 stocks that could make the cut and enter the MSCI, index this time around. First on the list, Zydus Life, expect inflows of close to $184 million. Prestige Estates, close to 160. Dixon Tech, 237. OFSS around $150 million, Oil India around $178 million. Vodafone Idea could make the cut this time around. Almost $275 million of inflows could be seen over there. RVNL2 could make the cut. Now, one very important development that is likely to happen this time around is the likely weight increase of HDFC Bank. Remember, HDFC Bank in its shareholding pattern indicated that there is now enough foreign headroom for MSCI to go and double up its weightage. So IIFL estimates almost $2.7 billion of inflows could be seen over there. Now, apart from the August review, there is also a smaller event today. Indus Tower that saw a block deal happen, 1 month ago, where Vodafone, went ahead and pared its stake. On the back of that, there was increased free float, and today there will be a weight increase, in the MSCI index itself. Around $140 million of inflows expected in the last hour of trade today, which works out to around 2 times the average daily traded volume. Important development. We'll keep an eye out for, when the actual, MSCI review does come out.
Thank you very much for that. Get into a break. We'll come back with more on the markets and commodities. Stay tuned.
Welcome back. Let's now talk commodities. We have Manisha joining in, and she's focusing on copper today. Manisha.
Well, I'm looking at metals as a sector which has seen constant declines for the previous week, and this week doesn't seem to be auguring any well. I'll focus on copper, where the prices have now declined to near 4-month lows. From an all-time high of $11,000 a ton in the month of May, we seem to be near around $9,200 a ton at this point in time. Well, there are demand concerns from China. It has been weaker economic data. The first quarter GDP numbers were also on the weaker side. And then there are the third plenum meeting in China also has ended without any addressing any economic challenges there. The US also is expected to hike tariffs against Chinese goods, and that is weighing onto the prices there. And then the US home sales have seen a decline, the steepest one in last couple of years. The July factory orders from Japan also have come in on the weaker side, below 50. So everywhere that you look, the economic data has been weaker. The Chinese manufacturing and services data, now that comes in the next week, is something that the street will keep an eye on. There is some positive cues, especially in Asia, when it comes to India, where after the budget, the expectation is that India could be looking at spending more on infrastructure, and that would lead to metal demand coming higher. But if you look at the LME and the China inventories, they are the highest in since May 2023, and there is a discount if you want to buy copper and various other metals right now, and that tells you about the recent trend in prices. When you look at the metal prices in last 1 week, we have seen a decline across board here. Copper has declined by 6.5% in 1 week itself. We have zinc down by 6%. Aluminum, nickel, lead also have declined anywhere between 4 to 5%. And you have tin, which has declined by 10% in the matter of last 1 week itself. So unless you get stronger data coming in from China or the rest of the consuming world, the expectation is that you could look at this pressure continuing for metals.
Thank you very much for that. And with that, it's a wrap on Trading Hour. Hope you enjoyed the show. Stay tuned. Halftime Report is up next.